More than 50 don't read. Unless you want to count text messages. And Instagram. They just don't read. They don't read. Right? Some people don't read for political reasons, right? And they just don't trust it, but they don't read it. It's a sad state of affairs, but it's true. They don't read. Just because you don't read doesn't make you stupid. That makes sense. I got a plethora of friends that don't read, but like they can fix your car. They're great farmers. They can work on your house. So some of them they don't read because they just don't have time. That makes sense. But so, you live in a bubble. It's a anomaly. All these educated people you live around, you know, this area ranks what worldwide as far as education. That's how y'all know first. It was first. You're a bubble. I call it being a Philadelphian and eat Philadelphia cheesesteak. You think everybody in the world's cheesesteaks are the same as, oh yeah, it's just like the one on Broad Street. No, it's not. You're in a bubble. You go to Iowa, you find out real quick, cheesesteaks in Iowa aren't even close to cheesesteaks. Right? And you're like, oh, that's right. You got special. Yes, you got special cheesesteaks. Everybody with me? It's like wine here. Wine here is fantastic. Go down to Tennessee. Now they got great bourbon in Tennessee. They ain't got great wine. Makes sense? I mean, a lot of places have their niche. Don't get a niche confused with, oh, this is how it is everywhere. And here, the niche is education. You don't think everybody is smart, everybody goes to college. Most of America don't even graduate high school. They forget college. No, I said this area, not the US. This area. Right, this area. Not America. No. If you took, if they're doing a project now, if you took DC, Richmond, the Richmond area, the Richmond metropolitan, they calling it the triangle. So you took DC, Richmond, and Tidewater out and separated and made it two states, right? The DC, Richmond, Virginia, Tidewater area will rank like fifth in education, or fourth. It's very high. And the rest of Virginia will rank 49th, just above. I think it's either Arkansas or Mississippi. Right there. So we've got a long way to go. This area, as far as understanding our cousins in the South, in the West, Southwest, and direct South, because they're facing something that we are.
Do you think we should? Do you think we should stop? Do you think we should stop funding schools with property taxes because that in turn has people in more poor areas getting worse education?
No, I just think we need to fund education. Like especially as Virginians, right? Like Virginians and the people of Massachusetts, the fact that we're not killing the people of Massachusetts as far as education is a little bit of that. But I mean, what are our founding fathers about? I mean, what is Jefferson and Madison and Webb and Mason? What are they about? Huh? Education. That makes sense. They were building universities here long before it was even thought of in states like New York, South Carolina. Does that make sense? So I think that it now for what other states that's fine. Like Mississippi, Arkansas, however y'all want to do it. I'm not gonna run in there and say Tennessee's doing it wrong. That makes sense. What I'm saying, we have an ethos in Virginia, and that ethos does start with education.
What I'm saying is that
Like, so I want to hammer this home. Like Texans, their big guy is Sam Houston, right? Did he build a school? No. Was he about war and shooting people down? Yes. He's a military man. So what are all the Texans about? Their Second Amendment rights. And that falls in line with the dominant person, the dominant founding father. Now, when it comes to our founding fathers, I mean, Washington was a military man too, but he's a different military, right? Even Lee is a different military man, right? But outside of those two, the rest of them, Jefferson, Madison, Mason, Webb, are all men of education and learning. And they built schools. So I sometimes get confused when Virginians, like, we should just fund and educate our, our citizens. Does that make sense?
I agree.
We should always be.
I think you misunderstand.
Oh, okay.
I was saying that schools shouldn't, not that they shouldn't be funded, that they shouldn't be funded by property tax.
Oh, no, I got you. What I'm saying is for us, we should just fund it. I don't care how it happens. That makes sense?
And
instead of like,
determined on property because they're not.
it should just be determined. We should be like, we're gonna have the best schools, bring out the best academics. That's what Jefferson said. That's what Webb said. That's what Mason said. They didn't care how it was funded. Right? Right. I agree with it all. I think we set a bar. We want to launch, spaceships to Mars and Venus. We set that bar and we meet it. However we meet it.
If every school in America was all funded by the government, would that be considered socialism?
That would be, textbook, right?
Textbook
Textbook.
funded by the government.
Not really. Socialism is more, it takes a lot more to consider something socialism. Socialism isn't just government does something. You have to pretty much completely eradicate capitalism for something to be socialist. Yeah, because you need to get rid of the
What the Chinese got little pockets of capitalism.
Yeah, but
So I'm
it's just
saying
more
like textbook, just textbook. I'm not talking about, you're thinking more theory. I'm just saying by definition of the school. So, to get back to it, full disclosure is they disclose everything that's material in the financials. And what is material? Things that can do what?
Influx of resource,
Huh?
material called influx and deflux.
No, it can do what? I don't need it. This would be a business.
To influence the decision of a rational investor.
Right, it can change or influence the decision of the rational investor. Everybody with it. So everything that can change or influence the decision of a rational investor has to be with the finance. Going concern assumption. We assume two things about a company. This one will start some conversation. The first thing is pretty easy and rational, that you will be in business. I was to tell my grandma this week, you will be in business next year. Everyone with me, right? So when you say, they say they don't have any going concern, you'll see it on an audit report. That means that first, they believe they'll be in business. And number two, probably a little bit more importantly, is what? The company will be doing the same business. Now, this one's a little bit tricky. The company will be doing the same business. Companies pivot all the time. And you need to keep an eye on your company because you will be, I'll give you very famous company. Apple, what do you guys think about as Apple today? When I say Apple, what product do you think of? iPhones, right? 20 years ago, Apple was not about iPhones. It was about iPods. 30 or 40 years ago, Apple was not about iPods. It was about what? MacBooks. That makes sense. Now for you, you're looking at it in retrospect. So to you, this may be a natural progression. But for an individual like myself and others who have lived it, it's not a natural progression to go from laptops to iPods. So let me stop there for a moment. When iPods were made, they were nothing but a substitution for something we call a Walkman. You know, I don't know if y'all know this, but we used to put like CDs and okay, cool. So they were nothing but a substitution for that. Would you feel like your computer company is also a Walkman company? Do you think those are two both? They're not. You were with. And so that transition that they did between from laptops being a majority sell of laptop, I mean not laptops, really they were doing computers at that time, hard desktop. To going into iPods was very tricky. They didn't get a going concern. And even academics, we talk about that to this day. And they probably should have got a going concern. Because just to tell somebody, oh, you can have 100 songs on this phone, it wasn't even a phone, on this device, is not technology. That makes sense? Back then, it was only an upgrade to a Walkman. Everybody with me so far? Then they went from iPods to what? iPhones. You feel like an iPod and iPhone are the same thing? So that is a company that if you invested in 1980, you did your research and you went to Apple because they were a leader in computers and technology. And now in 2025, although you probably have made yourself rich on Apple stock, are you still investing in the same company? Only in name. Only in name. That makes sense? Because now they're not doing it. They do laptops, they do desktops, but is that their main thing now? And eventually their main thing isn't going to be the phone. That's what they're saying. Eventually they're going into what those Oculus, the eyewear and stuff like that, in other dimensions. So does everybody understand? When you say going concern, there's two concerns. Is the business going to be in this sector? Is they going to be doing the same thing this year, next year? Are they going to be doing the same thing and are they going to be in business? And we assume that every company will be doing that. But sometimes they will pivot. I'll give you a great example of a company that you guys know. Tesla. What's the number? Did I tell you what's the number one revenue grower in Tesla? No, that's all. But that's close.
Research with XAI's anyone?
No, but that's not. I'm not saying they don't have ownership of it. I'm just saying that's not their number one. Right? No. No. Huh? Both of y'all are close. Solar panels, batteries, the charging centers. Last year, Elon Musk said on the conference call, he feels like in 5 to 10 years from now, you won't even, your kids, he said, really what he said was your kids will not know Tesla as a car company, but as a charging company, an energy company like Exxon. Sure. Because the growth in the money that he's getting on the charging center is growing so fast, it's far out past it, facing cars and everything else. Everybody with me? So that's a company. Now, charging centers, That is an ancillary business, but is it organic for Tesla? Is it organic, meaning does it go with their business of creating cars? Yeah. It's simple, yeah, it does. Everybody with me? For Tesla, how many charging centers did you ever see? None. They are the innovators. They knew they needed to make charging centers to have places for people to charge their cars outside of their home. So they're the innovators.
So like when these companies pivot, is there like a way that they can follow to not get so that they can claim to toe the line of not getting,
The truth,
yeah.
you just pay off your audit.
Hmm.
And if you do it slowly enough, then that the auditor doesn't say it. It's the truth because I've been in a company and that happened. We pivoted from one technology to the other and we just gave the auditor a different and did it slow. And as an investor, right, you'll see the growth of one portfolio out of another. That makes sense. Like if you're investing in Tesla right now, you're not just like you got to very good SpaceX, other things that they have, right? So you know, Tesla is not just cars. You know, it's apps and driverless vehicles and all this other stuff. So you know, well, here's a portfolio. The cars is the main thing right now, right? It's got the most total revenue. But man, this thing over here, it's growing fast, right? It might not be $1 billion revenue, but man, it got to 100 mil really quickly. And it's coming to $1 billion really fast. And so you realize, well, these two things go together. The cars are driving the charging centers. But man, those charging centers are getting big. And now that they're cutting the charging centers on to everyone, this thing is really growing fast. And so eventually you'll be like, well, this is bigger than this. Are you probably going to sell your Tesla stock? No. Right? It'll be like Disney. They got Star Wars and they've got Marvel.
Mm-hmm.
You're like, oh, this is the best stock I ever had. Well, maybe not Disney. So, but like for Tesla, you'd be like, oh, this is a great stock, and you'll keep it. So most of the time, your investors won't make an issue of it because of the money. Money changes a lot of issues. It makes sense. Remember what did Biggie Small said? Money will make not more money, more problem. Money will change me from big, black, and ugly to tall, dark, and handsome. Right, right. So going concern is not just it stays in business next year, but it's doing the same thing. And there's an organic way that it might have a different business and transition. Does everybody understand that? Going concern? Monetary assumption is that when you pull the financials off a certain, like if you pull off the New York Stock Exchange, it will be in US dollars. So when you look at financial statements, let me show you how to pull up a. When we pull up financial statements, it's not the most user-friendly. There are Google Finance, there's Yahoo Finance, where the financials are user-friendly. But if you really want to be sure that your financials are right, if you go to the US SEC EDGAR site and search the filings, and find, let's see, well, since we talked about Tesla so much, we'll just do Tesla. And 10K is their annual report, 10Q is their quarterly. We'll just take their last quarterly. On the financials, consolidate financials, you'll notice that, well, for them, they were nice. They put $1 sign. They don't have to, because the monetary assumption assumes that we already know these are in US dollars. That makes sense. So most financials you'll look at, they'll just give you the numbers. You will assume that they're all in US dollars. If you were to pull it off the DAX in Germany, you would assume it's in euros. If you were pulling it off the FTSE in London, you would assume it's in the British sterling pound sterling. Everybody with me? Mhm. So that's what that assumption is. You know, it's important to know these and maybe memorize them because as we go forward, they'll help you when you create your financial statement. Time period assumption is that we can break down the financials in certain time periods, whether it be, for us, it'll be quarterly or yearly or semi-annual. But you can do monthly, weekly, and so on. The lower time periods like daily, weekly, monthly, that's mostly a managerial account. Here, when we're giving the financials to external users, it's probably either going to be quarterly, semi-annually, or annually. Everybody with me? Business entity assumption. Oh, let me explain why we do that. We do that because most external users don't want granular data. They want to see the overview. They don't want to know overtime for last week. Everybody with me? That's not going to change their mind about investment. So inside the company, your manager does want to know the overtime report for last week. That makes sense? So all right, business entity assumption means that the business and the individual are separate. They're two separate entities. They're not the same thing. So if you go down here to McDonald's, this is actually a cornerstone of our capitalist society. It really helps our entrepreneurial spirit because it means that you can't sue the entrepreneur for something that happened in the business, right? You go down to McDonald's and the person burns their tongue, you can't sue the CEO for his personal effects, like his house or his kid's college fund. That makes sense? You can only sue McDonald's and then his investment in McDonald's. Now that's at risk, but it's not like his personal stuff. Everybody with me? So we separate the business and the individual. So, and when we're doing the financials, sometimes I'll give you a transaction. It happens to the individual. That is not a business transaction. That makes sense. We gotta separate.
If somebody's co-signing on something like a lease agreement, LLC with the primary, can't you still come after assets?
Yeah, and you co-sign it as an individual. They'll treat you as an individual. So the lawsuit will be the LLC and the co-sign. You have to be aware of that. Those are the treatment. But we do treat businesses, corporations as they have person in it. We treat them as people under the law. So the only thing that can't happen to a company is they can't get the death penalty and they can't go. But the rest of it they have. All right. For purposes here, the business entities, there's three main business entities: sole proprietorships, partnerships, and corporations. Let me see. Sole proprietorships they are not government, they're not government entities. It's just you start doing business and you start trying to make a profit, you get a sole proprietorship. That makes sense? Or recognize a sole proprietorship. Partnerships is when two or more people come together in a business. I'm definitely not a fan of partnerships because partnerships have this thing called a mutual agency, which means one partner decides something, all the other partners are bound to it. When I was a tax auditor, we had a case of a local bill office. Yeah, they hate my guts. I audited a guy one time, another doctor. If I ever see him, it might be a misunderstanding. But I always tell people, I love Jesus. I'm a Christian. I'm saved, but Jesus ain't come down here and delivered me yet, so while I'm not delivered, these hands, right? These hands fucked up. But I had a doctor once, he got mad, he was, I audited him, and I thought it was him too. I had I got sick, and I had flu, and I came in and he recognized me, but I was delirious because I had a high fever. And I was like, I think it's that food. I think I was like, this is that food. And I couldn't really worry out. That dude gave me an inhaler and sent me home. And then I was like, hours later, I was like, I think I got the flu. And my wife was like, I think you need to go to like, so I went to like a regular doc in the box. And they were like, who gave you this inhaler? And I was like, oh, the doctor I went to see. They were like, that's a misdiagnosis. So they gave me, what they give you for flu. Sucks too. But so I went home. Y'all know they don't these doctors are horrible. And then but when I got better, I went back and researched. I went and got the prescription and got the guy's name, and I found out it was a guy that I audited. And I tried to, I was gonna go after we were gonna come after him. But then I was like, you know what, this dude, he gonna be like, oh, I didn't know, blah, blah, blah. I was like, I'm gonna be in court, and he said he don't know, I'm just gonna go on. Right? I'm gonna come up on the stand, punch him in the jaw, man. Cause I was like, dude, to like that type of character, like he was alone. We didn't even hit him for that much money. I don't even know if we hit him for much. Yeah, we didn't. That audit was trash. And I'm like, for you to have that type of character to still like, you shouldn't even see me. That makes sense. You should have been like, yo, he audited me. I shouldn't see him. But to still see me and do what you did, I was like, dude, if Jesus ever tell me, that's it right there. Right. Right. I'm still from the court meeting sometimes. That's that dude right there. I'm like, what? So, but
Your assets at risk if you get sued.
yes, they are. Right. Your person has it.
Partnership.
Huh?
If you're in a partnership and.
Yes,
your
they can
business
be.
partner does something wrong, or your asset.
Right. So this is my scary story to you. The partnership one is there's a dental office in this area that was on a partnership. And two of the partners were committing a fraud. Well, I'm sorry. We didn't, well, I don't think, the case didn't get that far. So what I don't think we got them for fraud. I think we just got them for the taxes. But it was a long case, wiretaps, the whole nine, right? And two of the partners, they were actually related. And we had them. The third partner, we knew didn't have anything to do with the fraud. It's not, but with the tax issue, because we had them on wiretap. We had wiretaps of him calling the partners and asking them, hey, help, what's this thing I'm getting from, and they'd be like, oh, just give it to our tax account. And the tax account, all of them were in on it, like everybody. When I say this was a big one, we rounded up everybody. We went after their sister, their cousins, everybody, right? Like they were committing a massive fraud. Well, it wasn't a fraud. You didn't get them for fraud, just in case they run in here and they feel good. Ooh, fraud. Tax issues. They call it taxes. Multi-million-dollar. So I remember the partnership, we got them for like 10 million. I think it was like 10 million. And so when we sent out the bill, we sent 5 million to one partner and 5 million to the other, just the two partners that committed the fraud, right? Their attorneys called us and was like, you need to, this bill is wrong. You got to split it 3 ways because it's a partnership. And the other partner, then this needs to be 3.3, 3.3, and 3.3. And legally, they were correct. redo the bill, and send the partner that we knew had nothing to do. We had years of wiretap on these guys. And we knew he had nothing to do with it. And we had to send him a $3.3 million bill. And I was the one that got the great, to call him and inform him about his bill. And that dude cried on the phone like a punk. He cried on the phone. And he was like, what did I do? And I can only tell him, huh?
That's what he has to say.
He didn't snitch.
Oh, yeah, I thought he was the person on the inside.
No,
Oh,
we didn't have an inside person.
oh, you
The inside person was Verizon.
Oh.
How do you snitch?
Right.
Yeah.
No, they kept talking on the phone.
Oh. no.
Like, it was like, it wasn't a hard case. I mean, what they had done, they really should have got jail time. Because they had also convinced, they did a, you know how you do orientation for your employees? They would do an orientation for their employees and encourage their employees to pay more taxes. Because, taxes go to build our roads and make our places. The whole time, they were claiming they lived in Florida and were evading Virginia taxes. Not only were they doing that, they also so their employees were claiming like zero and getting the maximum amount taken out. Behind their back, they were claiming their employees were like 3 or 4. And then the difference between how much taxes they were sending us and the amount of tax their employees were paying, they were keeping the money. That was some cold shit. I'm telling you, and they were like punks. They weren't even, I'm not talking about no gay, this ain't no Nino Brown, Suge Knight story. This is like some 120-pound lightweight 2 kids. If I brought them in, you'd be like, what? They like the normal dentist. They're dentists. They're just normal dentists.
They just not paying tax and the father
Right, they weren't paying any state taxes. That's what got them on our radar. I mean, you're a dentist and you claim you live in Florida. Right. They literally went to court and said, well, every day we fly our private jet back to Florida and spend the night in Florida. And then we fly back to Northern Virginia in the morning and do people's stuff. It was ridiculous. It was the most ridiculous. Like, yeah.
Isn't that really easy to prove false?
Yeah. Especially when you wiretap it. Back then, you guys think, okay, here's a correction. When I say wiretap, I'm not talking about cell phone, I'm talking about house phones. This happened in the 2000s. So we're talking about house phones. Yeah, so, yeah, we had them on the phone talking at night. And they were claiming they had that. So that's why I warn people about partnerships, because there's a thing called mutual agency. And mutual agency means that your partners could be committing a crime and it envelops all of you into it. That makes sense? And so when they find against the partnership, they're also fighting against you. You might not have a clue what happened. And it could be that. Just like that guy. He got hit with a $3.3 million. And then corporations are legally formed. The entities under the government, think of LLCs, your S corps, your C corps, all that falls in that umbrella. And you can either have stockholders or you could be privately held. But everything you invest in that company, that's at risk, nothing else. That makes it your personal thing. So that's where the business entity assumption comes into play. All right, so now we're going to get into starting to teach you the accounting deficit credits and the accounting. So let's start with the accounting. The accounting equation for everybody who doesn't know, or if you're in Business 100 and you haven't gotten to the financial statement, yeah, that's your final. How many people in business one hundred right now? I'm blessing you. You might, you'll kill on your final. You might not do well in here. You do great business one hundred at the end. All right. Yeah, the accounting equation is assets equals liabilities plus equity. Assets equals liability plus equity. That is the simplified accounting equation because liabilities, I'm sorry, equity. Equity equals common stock or capital N. We're gonna call it capital N for a while. As we're learning the material, we'll call it capital N. So you can see the inflow, but it's actually called common stock minus dividends or capital out plus revenue minus expenses. So please remember equity equals capital N minus capital out plus revenue minus expenses. We're going to utilize that. So I think it's the way I teach debits and credits a little bit more streamlined. That makes sense. It'll help along the way. The first major thing that you need to do, or I would suggest you do, is to memorize what are assets, what are liabilities, and what falls into the equity section. So assets are accounts, and they are these accounts. Let me tell you this, you're gonna see this slide in chapters 1, 2, and 3. Do you know how important a slide has to be for it to be in chapters 1, 2, and 3? The same slide, it's gonna be important. Assets are things like cash, vehicles, land, buildings. Accounts receivable, did they put it up here? Notes receivable. Supplies, we're gonna talk about supplies. Resources that are owned and controlled by the company. Those are assets. Liabilities. Is everybody good here? Liabilities are things like accounts payable, taxes payable, wages payable, and notes payable. The only liability, oh, notes payable is something that you owe more than a year. The notes is a way of telling us the time period. So accounts payable are things that you owe under a year. Notes payable are things that you owe over a year. This is a very good question. The only thing that you're gonna see in a liability that is going to be outside of a contract liability, but that's more advanced. We'll talk about that later. But the only account that you'll see under liability that won't be a payable at this point in the game is unearned revenue. Just like it says, it's just revenue that was not earned. You haven't earned it. You received it, you haven't earned it. With that, let me say something historically about accounting. Accounting is Western accounting, what we are learning, right? Many of you come from a culture that had accounting before Western accounting, but you may have done accounting a little bit different, right? Your culture. Nikolai Pacioli. He has a statue of himself in Italy. And he has two statues. There's one in Venice. I saw this Venice statue in the picture. And then there's one in his hometown. Nikolai Pacioli is invented what we call double entry accounting. He is from the church, the Roman Catholic Church. Everybody was with. During that time, the Catholic Church came out with many, many great ideas and intellectual. They had a lot of intellectual pursuits and a lot of intellectual inventions, right? Most of the things we know through Mendel and genetics comes out of the church. Counting comes out of the church. Certain Copernicus and astrological things that we have is coming out of the church at that time. Now, here is a negative about that. Back then, the church wasn't too high. Catholic Church wasn't too high on women, right? So just like Bobby Boucher's mom, the Catholic Church back then thought that women were the devil. So, monasteries and churches, the nuns were on one side and all the monks were on another side. That makes sense? Like in totally different built monasteries. That makes sense? Everybody with me so far? So there was very little to no female influence in a lot of these studies in the beginning. Now, why did I bring this up? Because when you get men together by themselves to think of intellectual pursuits, you make it great pursuits. But there's normally two things that happen. First, they'll come up with these really big names, unearned revenue, right? Depreciation, accumulation, amortization. You think, ooh, you're going out the big words. They got the big ones, right? But when you get down to it, it's very simple. It's very, very simple. So men have a way of making simple things look big. But they're not big, they're simple. Everybody with me simple. So things like, and as we go on, you'll start to see this more and more. But things like unearned revenue, and people say, well, what's unearned revenue? It's got to be something big. No, it's just revenue you didn't earn. That's it. Right? it's in the word. That makes sense. We'll talk about ROI, which is ROI. You might have seen this. We'll talk about ROI. That's return on investment. And a lot of people will say, oh, this has got to be some complicated equation that we don't know. Well, a synonym for return is net income. As a result, return on investment, the equation, and from here on in, I'll be putting NI for net income, so please note that. So the equation for return on investment, ROI, is return net income on investment. Literally, when you say ROI or return on investment, you're actually saying the equation also. Everybody with me? If you're with me, give me a thumbs up. Okay. So I'm bringing this up to show you that some of these concepts and different things that I'm going to show you, they are going to sound bigger than they are. And then I'll show you that they're very simple. All right, equity, just like I told you before, capital in, capital out, retained earnings is number of revenue minus expenses. Oh, the dividends will be in there too, but we'll talk about that one. So this, when we take into account the idea that equity equals capital in minus capital out plus revenue minus expenses, the actual equation comes to assets equals liabilities, when I start doing the equation, I'm gonna start writing it like this. Plus capital N minus capital out plus revenue minus expenses. This is the actual accounting equation. That's the real accounting equation. Everyone with me? This is a very, very powerful equation. Now, this equation must always be in balance. How do we balance this equation? Once you think of it as this equal sign, sometimes I think of it as a fault line. And what this side assets has to be equal to this. Let me take a second and tell you what is equal to. What this equation is saying is that all the assets in the company are equal to, no, I'm sorry. All the assets in the company come from three different places. All the assets in the company come from three different places. The first place, which is represented by liabilities, is just borrowing the money, borrowing money or borrowing assets. Everybody with me? It just took a lot. The second thing where you can get in an asset is through investors, right? How do investors put money into a company? They purchase common stock or they contribute capital, right? How do they take money out of the company? They receive it in dividends. Right? So investors bring in assets. And the third way that you can have assets in a company is day-to-day business. What do? Right? You McDonald's, you sell hamburgers, right? If you receive more money in hamburgers than you paid out to produce those hamburgers, let's say you receive $1 million for selling hamburgers today, and it costs you $500,000 to make those hamburgers, then you have $500,000 in profit, and that's your asset. Everyone with me? Now, I believe there's only two ways that you can keep this equation equal. Really only two ways. The first way is you do the same thing to both sides of the equation. Right? So let's say you borrow $50,000 in cash, right? You're going to increase your liabilities by 50,000, and you're going to increase your cash by 50,000. That's doing the same thing on both sides of the equation. That's it. Everyone with me so far? That way you can keep it equal. The other way that you can put it,
No, I was just gonna ask a question where, let's say on the test or a question where you give us all the variables, when you tell us to solve for one, as if it's a math equation.
they're all.
Yeah, but for example, let's say you want us to find the liability. We have all the other variables, we have the asset and whatnot.
No, on your exam, it will say, it'll look like this. It'll say like Chase invests $30,000 cash to start a company. And you have to know that's an increase in your cash and an increase in your capital in or your contribution. Does that make sense? That's what you need to do.
Okay.
That's the start. I haven't done the debit and the credit yet, but that's what it is. The second, and that is actually reflects what I was talking about, right? So we're gonna increase the cash, which is an asset, 30,000. And we're gonna increase the common stock, that's capital N here, increase this by 30,000. So if we don't think about this, we just think about this. If that's your first transaction, then assets equals 30,000. Then all of this equals 30,000. We're good. Everybody with me? So I think I might have had this on a slide too. Yeah, see. Everybody with me? The second way that you can make sure that this is equal is do the same thing, no, do the opposite thing on one side of the equation. So in this case, let's see if the next one is that. Yeah. So the next one is the company purchased supplies, paid $2,500 cash, right? Cash is an asset. But we decreased it by 2,500. Supplies is also an asset. We increased it. So that's an opposite thing. The opposite is the same, but we're doing opposite transaction on one side of the equation, which is just the asset side. So it's going to look like this. It's going to be on the asset side of the equation. Subtract it here, add it here, that zeroes it out. So we still have 30,000 on this side, 30,000 on the liability. Does everyone understand that? Okay, let's fly. The next transaction is the company purchased equipment for $26,000 in cash. Cash is an asset. We use $26,000 in cash to pay for the equipment, so cash is going down in the company. So we're going to decrease cash in the company. Everyone with me? We're going to use it to buy a piece of equipment. The equipment is also an asset. So we're increasing the amount of equipment that's in the company. And so when we put this on the accounting equation, it's going to be on one side of the equation, right? We're still just dealing with assets. We're going to add 26,000. We're going to subtract 26,000. So it's still $30,000. Assets equals liabilities plus equity. Everybody with me? The next transaction, we're going to purchase supplies of $7,100 on credit. Credit is a liability. Everybody with me? That's borrowing the money. So we're going to increase the amount of money that we have borrowed, and we're going to increase the amount of supplies we have. So everybody with me? And the supplies are an asset. So we're going to have an increase in the supplies, increase in the borrowing. 37,100 is the total. So we're still in balance. Questions? What?
So it always needs to be down.
Always needs to be done.
And
I'm glad you used the word need. Right. It's not a war.
so when previous equipment purchase was with the equipment purchase in value, and how does that change the
we'll deal with depreciation in chapter 9. Right, it's not a, right now, I just want you to know how to put equipment. Later on, we're going to have a subcategory, it's gonna be called a contract asset, and that's gonna adjust the equipment. But right now, I just want you to see how we put it. It's gonna be a good question, chapter. Boy, you got it. Or maybe it's chapter 8. Let's see. 11 is short-term, long-term liabilities. 10 is, oh no, it is chapter 9. 11 is long-term liabilities. No, sorry. Ratios, statement of cash flow, statement of owner's equity. No, it's 8. 10 is long-term liabilities. 9 is short-term liabilities. 8 is long-term liabilities. Long-term assets, I'm sorry. So 8. We'll read chapter 8. God, I'm getting old. I used to watch the old timers do that. Like they knew every chapter, and I was like, wow, it's amazing. Now I'm that guy. I'm like, oh yeah, that's chapter, this chapter. Like, provided consulting services to a customer and received $4,200 cash. So we're increasing our cash by $4,200. Everybody with me? And we're also increasing our revenue because that's consulting services by $4,200. And that revenue is under the equity. And so the accounting equation, we have the $4,200 cash and the $4,200 in the equity under revenue. Questions on that? And we're still in balance. We have 41,300. Next, we've got rent paid. So they're gonna pay $1,000 in rent and they're gonna pay $700 in salaries. When we pay that in cash, we're decreasing our cash, that asset. We're increasing our rent expense and we're increasing our salaries expense. Now, although we're increasing this and it says it's a negative, it goes down. What this slide is showing you, an increase in expense is a negative. Everybody with me? So that means that it's actually reflecting down. And always remember, a negative times a negative equals a what? Positive. So we'll see that maybe in this. So here we're decreasing it 1,700, 1,700. But these are increases, but because it's a negative, they're negatives. Everybody with me? It's minus expenses. And so it keeps the equation in balance. Next, provided consulting services $1,600 and rented the facilities for $300 to a customer. They did it on credit. When you have not received the money yet, it's called accounts receivable. When you have not received the money yet, it's called accounts receivable. When you have not paid the money yet, it's called payables. Everybody with me? Receiving the money is a receivable. Paying the money is a payable. So we haven't received the money yet. So we're going to increase an asset called accounts receivable. And we're going to increase our revenue accounts. And so here's our accounts receivable, 1,900. And here's our two revenues for 1,900. And the account is still in balance. Everybody with me? We're not doing debits and credits right now. We're just doing increases and decreases on the accounting equation. I'm taking it slow. You'll appreciate this a little later. You'll be like, oh, he was so nice to me the first week or something. Right? And then all of a sudden, put the hammer down. All right. A client in transaction 8, that 1,900, they paid it. So when they pay, we're going to increase our cash, our asset, and we're going to decrease our accounts receivable. Both of those are on the asset side, so they're opposite but equal transactions. So we increase our cash, decrease our accounts receivable. Keep the cash. Everybody with me? transaction 10. Fast Forward pays $900 as a partial payment for supplies. So we're gonna pay partially our supply, for what we took out for supplies. So we're gonna decrease our cash because we're paying our cash out. And we're gonna pay down what we owe. So that liability is gonna decrease because we're paying down what we owe. Everybody with me? And so like this, a decrease in cash and a decrease in accounts payable. They're on two sides of the equation, so we still have an equal, our accounts will still be in balance. 11, we're gonna have pay out a dividend. It's gonna look just like the expenses. So we're gonna decrease our cash. We're increasing our dividend, but that dividend is a subtraction. Just like the expenses were a subtraction, dividends are a subtraction. So we are going to, right? Subtraction, so it's gonna come as a negative. So minus 200 in the cash, minus 200 for the dividends, we still have a balanced equation. But
What motivates the company to have it?
everything. If you don't have a company that's not, if your company's not paying dividends, it better be a damn great company. Like, the only companies that I have that don't pay dividends is like NVIDIA. And I was in NVIDIA a long, long time ago. Did I show y'all that? Yeah, I've been in there for a long time.
That's the highest dividend, right? So-
No,
No, it says higher than that. 8-10% is the highest that AT&T did.
not the highest any company gives.
Oh, okay.
Because I know there's so many people online nowadays, and they're like, oh, I made this, and I was in NVIDIA, and I was in this company early, so I want to be you. I'll show you my.
Who's your active player?
He'll tell you in a second. Not you, him.
Oh, man, so I just gotta check it out, gotta check it out too.
Let's see if I can find it. Oh, it's down since yesterday. What percentage did I gain on it? Well, tell them, you gotta tell them.
That's a good percentage.
What's the NVIDIA percent? What percentage have I gained on it? Yeah, that's the double.
375.
Tell them.
375%.
That's after yesterday.
But it dropped it yesterday, didn't it?
When you up 400%, you can use it or something off the top. It's cool. It's cool. I'm up 3%. So, yeah, when I tell you guys, like, I'm an investor, I know my stuff, I know my stuff. And so, like, NVIDIA, I'm not worried about them paying a dividend right now, 'cause I'm up so high on it. But most companies, I'm pretty stringent about it. I gotta see something.
Is this something you do just for their balance sheet, or is it actually beneficial to the company itself?
It can be beneficial. Well, first of all, if you want your investors to stay in, right? Sometimes you'll pay them a dividend just to keep them in the game, right? Because they know, oh, I'll get a dividend next year. Also, it's been proven by the University of Pennsylvania Wharton School of Business that 70% of the gains, and it's probably up to 80 now, in the stock market have been through stocks that give out dividends. Those have been the ones, not the.
So good. Like, I think, like,
Yeah, it depends on what company you got.
I mean, like, when I was, as I said, I looked at, I think AT&T was one of the highest, I think it was 80%. or something.
That's now because the stock market's up.
Oh, okay.
I mean, like I've got Exxon, and my dividend is 10%, over 10%. But I didn't get it until they had that crisis where the barrels of oil went down below zero. That's when I bought Exxon. That's when I bought Chevron.
Is it quarterly or?
They pay me quarterly.
Okay,
Yeah, they pay me.
they can't do that for quarterly.
I'm very chilly cold when it comes to my stocks and my dividends. You gonna pay me. Maybe, I don't know about it. All right, how much time we got left? Oh, all right, let me call roll. We're gonna stop here at the financial statements. I'm gonna show you financial statements. And then, let me see your book. Let me see somebody's book. Let's get some of your vocabulary. Your vocabulary. If you could do, I'm gonna assign you two things, it's gonna be pretty, yeah, you guys aren't ready for that. I'm gonna give you two, it's 3 through 8 and 42 and 43. So I want you to do, in your workbook, I want you to do pages 3 through 8, 42 and 43. That's gonna be your assignment for, when we come into class. Let me call the roll. Sorry, I kept you over a little bit. And, things will go a little, so on Thursday, that's what we will be working on. All right, Jake. Okay, Bianca. Louis. Jonathan. Oh, okay. Where'd you go here, Mike? Alex? Here. All right. William? All right. Luis? Or Louis? Okay, Louis. Albert? Alyssa? Casey? Fiernaz? Fiernaz? Be here? Lindsay? Sarah? Sarah Hinton? Hamza? Ishrak? Nicholas? Melinda? See you in the back. Johnny O? All right. Baltimore? Okay. Ebenezer? Jackson? Audrey? JD? Serena? Serena, sorry, Serena. Gabriel? Sorry, I'm so enamored with Serena Williams, like every time I see your name. Serena. Oh, yeah, that's my, yeah. Muhammad, Edwin, and Logan. All right. Questions, comments, or concerns before I let you guys go?
I do have one question. So I just transferred into this class. You guys only have the textbook as a physical